Hey guys, welcome to week 3 on our series in relation to the share market. This week is going to be the final week for this topic, and I'm going to get straight into it. This week we are going to talk about the lingo, so some of the common terms and phrases thrown around when it comes to the share market. So let's start with the income side of things. When we're talking about income, we want to receive income if we own shares, and they are paid, or that is earned, in the form of dividends. And a dividend is the income that you receive from the company that you own shares in. So if you own shares in ABC and they pay you a dividend, they pay you income, it's called a dividend. Generally, they'll do a dividend based on the end of the financial year's figures paid in September, and on the calendar year's figures paid in March. So generally you get 2 dividends a year, one in September, one in March. All right, moving on to the yield. The yield is basically the percentage of the income divided by the value, and you get a yield when it comes to a rental property as well. So in a rental property, say the total rent was $20,000 and the house is worth $500,000, then you got a 4% yield. Say for instance in the shares, your dividend income might be $1 a year, and the shares trading at $20. 1 divided by 20 is 5%. So your yield is 5%. Moving on to imputation credits. The idea of an imputation credit is it's a credit attached to your dividend to avoid to avoid the income being taxed twice. I'll give you an example. Say you own shares in ABC Limited, a public company, and they pay you $1,000 a year. You have to pay tax on that income, but ABC Limited also paid tax on that income. So let's say ABC made $100 million and the ATO rubs their greedy little hands together and says you owe us $30 million because they pay 30 cents in the dollar, or 30%, then they've got $70 million left. Then if they pay that $70 million out to shareholders in the form of a dividend, the shareholders receive their income, say yours is $1,000, you pay tax on it as well. So the idea of the imputation credit is it adds back on top the tax that ABC paid, and then you get taxed at the higher amount. And then when you say, I paid this much tax, it comes with a credit of what ABC paid. So it prevents it from being taxed twice. I said that in a confusing manner. If you want to know more about that, give me a call. Fully franked dividends are dividends where the imputation credit equals the company tax rate of 30%. So you might have a company that doesn't pay tax and yet they pay a dividend. So there's not been any tax. They're called unfranked dividends. If the company pays the full tax of 30%, gives you a dividend out of fully taxed income, they're referred to as fully franked dividends. All right, let's move on from income. Let's talk about direction. We've got the bid and the ask. If you're talking to a broker and they say, I've got the bid is at, that's the price that somebody's willing to pay for the shares. So ABC proprietary, ABC Limited, not proprietary limited. If it was proprietary limited, it'd be a private company. We're talking about shares listed on the market. They're publicly listed companies, so they're ABC Limited. ABC Limited might be trading at $5. Somebody's willing to buy the shares at $5. Somebody's willing to sell the shares at $5.10. So the bid is what somebody wants to buy it for. The ask is what somebody wants to sell it for. And until they meet, the ask might come down to $5. That's where it's at $5. If there's a heap of people wanting to buy and they're jumping over each other to buy those shares at $5.10, then they'll go up. If it's at $5 and the sellers want to sell, then they'll climb down under each other, to sell it, and the price will come down. Simple way to talk about it, supply and demand. That's the bid and the ask. A bull market is where the market is on the way up. A bear market is the opposite. A bear market is when it's on the way down. You can see the trend by the chart. If it's on its way down, we're in a bear market. If we're on its way up, we're in a bull market. What about long and short? If I was to say to you, look, I'm long ABC, it means I'm buying ABC. If I'm short ABC, it means I don't own the shares and I'm actually selling them. And the idea is you kind of borrow them from your broker and you sell them because you think the share price is going to go down. If they're trading at $10 and you sell them for 10, and then when you've got to buy them back at 9, you've made $1. So you've shorted the stock, long and short. What about some strategies? Let's say you own ABC shares and they're $10 and you want to buy them. You want to keep them long term because you like the prospects of them long term. They pay good dividends. Whatever it is, if the share price goes down and you bought them at $10 and now they're at 8 and you got 1,000 and you go, you know what, I might buy another 1,000 at $8. So then my average price is $9. So it doesn't have to come back as far for you to break even. So you're averaging down. Dollar cost averaging is not averaging down. Dollar cost averaging is investing the same amount of money every month. A lot of our clients do it. We call it piffing, paying yourself first, allocating a portion of your money towards your future self, towards a debt reduction or a wealth creation strategy. We're generally about wealth creation if your objectives are long term. And so with dollar cost average, we put the same amount of money. Might be $1,000 a month, might be $1,500 a month, might be $8,333 a month, which is $100,000 a year. I've got a client doing $12,500 a month. That's called dollar cost averaging. And if we move over to our final slide, some acronyms and ratios. It's funny when someone talks about the EBITDA, because I just think it's funny, but the EBITDA, earnings before interest, tax, depreciation, and amortization. Basically, it's the net earnings of the company without taking those things into play. Because if we want to, the company's doing well. I want to know what we earn without having to pay interest. I want to know what we earn without depreciation because it's non-cash expense, or without tax because I want to know my net earnings. Our earnings per share. Earnings per share is a formulator sounds like a robot. A formula which calculates the profit divided by the shares on issue. So if the company made $1 million in profit and they've got $10 million in shares, 1 million divided by 10 million is your earnings per share. That's kind of how they work that one out. The PE ratio, the price to earnings ratio. It's another formula valuing a company based on its share price divided by its earnings per share. The higher PE ratio means the share may be overvalued. And you start to look at that PE ratio when you start to compare shares in the same sector. So you might have the energy sector or the banking sector or the retail sector, and you can compare PEs based on shares in the sector and see if they're overvalued or undervalued. And the market cap, I talked about this one a couple of weeks ago. The market cap is purely the value of a company. How do you work out the value? Well, ABC's got 10 million shares and it's trading at $1. 10 million times 1 is $10 million. The market cap, the value of that share is $10 million. All right, one of my longer 7.5 minutes for this one, but hopefully you found that a little bit interesting. Hopefully some of those terms you might have heard and never knew what it means, and I've just helped you along a little bit. So that's it. I'll stop. Happy Friday. Have a great weekend. See you next week.